Evening, and thank you for joining. Just check. Okay, so thank you for joining. Just to quickly introduce the committee. So we're EHL Recap, and we provide tutoring sessions, and we provide material for students for the midterms and finals, and recap sessions like today's session. We're officially an EHL committee, and we're basically it's students by students for students. So Paul is a BOSC 4 student, so he did the exam last semester, and he also did a tutoring session, the recap tutoring session last semester for MA. So just so you know, in case you make a mistake on your exam, it's not EHL Recap's fault. We're just trying to help you here. Just don't blame us for that. But for the rest, please, Paul, you can take the word. And thank you.
Sounds good. Yeah, if you want to blame someone, you can blame Lorraine, not me.
I prefer not to be blamed.
So I heard that you have a revenue management exam after tomorrow. So we'll get this quickly through, and then you can always watch the recording. I understand that you're under pressure. I was in the same situation. Don't worry. So just a quick disclaimer. Obviously, I'll help you as much as I can. I'll answer all of your questions, but also please study. Do the exercises. But I'll get more into detail then after the presentation on some tips and tricks on the exam and like what I found hard and what I think would help for you. Well, a bit about me, but Lorena introduced me. I'm in BOSC 4. I'm currently in Vienna doing my internship at a hospitality consulting firm called PKF Hotel Experts. So yeah, that's it. Then I'll start the next semester in BOSC 5, and then I only have 1 year at EHL left. It's kind of sad. But hey, so I'll try my best today to teach you everything there is to managerial accounting. These slides are based on Dirk's class. I think he's still teaching, I would hope so. He was a very good teacher. And I'll try my best, see if I can remember everything, but I should be fine. And then if you have any questions or anything you don't understand, or if I'm going too fast, too slow, speak up, because I'll keep an eye on the chat, but you can always just unmute your microphone and speak up if there's something you don't understand, you want to clarify, or I'm going too fast. So let's start with the introduction. Introduction is mainly just the accounting and financial accounting, or as whatever they're called, like the specific gaps, like the specific rules that you have for financial accounting. You don't need to follow those. It's not audited, obviously, because it's internal. And the biggest difference is that managerial accounting deals with the future. So, for example, they predict, I think in 2021, we will have this amount of revenue, while financial accounting shows the past. It shows what actually happened. So the numbers, obviously, in financial accounting, they're real, they exist, they have happened, while the numbers in managerial accounting have not happened, since they're a prediction. And finally, what it's mainly used for, well, in managerial accounting, it's used internally to make decisions. For example, if they see that a certain product would make a lot of revenue in the future, they will push that product more. While financial accounting is used externally, basically, and is used by stakeholders, shareholders, whoever may be interested to evaluate the company and the financial health of the company. So then that's mainly the introduction and the difference between managerial and financial accounting. So the first section is all about costs. There are which is the most important ones. It's called, the first two are direct material and direct labor costs. Those together make the so-called prime costs. I remember we learned in BOSC 1 that the main costs are always material and labor costs and wages. So also here, that's the same case. Material costs and labor costs are also known as prime costs. And then we have the last one, part of the manufacturing cost, which is manufacturing overhead. And that is literally anything that's factory related that happens in the factory. So that could be anything from the light bulb that's used in the factory to the food served in the canteen of the factory, to the uniforms of the people working in the factory, or basically anything that happens in the factory is manufacturing overhead. for sure you'll have a problem in the exam where he asks to find manufacturing overhead. So that's always something good to know. Then the second part of costs are called non-manufacturing costs. That is everything that's not factory related. So marketing, sales, administrative, the CEO's salary, anything that's not production. How I like to remember it is that if it's taught at EHL, if it's marketing, financial accounting, 99% in non-manufacturing costs. That's, for me, always easy way to remember and how I used it during the final exam. Then, secondly, there's something called schedule of cost of goods manufactured. The schedule of cost of goods manufactured is basically, that's a shortened version, but it's a way to calculate the cost of goods sold when you only have the cost, starting from the cost of raw materials used in production. The full schedule is this. I would highly recommend to put this in your cheat sheet. Do not learn it by heart. I did not learn it by heart. There's no reason for it. But for example, this is useful if he asks you to calculate a specific cost. He wants you to calculate the total, which is at the bottom, and you have all the numbers. So ending raw material, purchase of raw material, ending work in progress, inventory, all those costs. So from using this schedule, you know exactly how to use the different costs to +1, -1, plus minus, whatever. And then to find then the cost that you need. So good tip, put this on your cheat sheet. That's what I did. You will for sure get a problem with this. And once you have this in your cheat sheet, it's very easy to do. You just find what numbers you have, what numbers you need, and then you go from there. Then, as we know now since forever, there's two types of costs, variable costs and fixed costs. I'm not going to stay here and explain what those are. I'm sure you all have heard of it and are sick of them. But the main difference that you need to know for managerial accounting is that the variable cost per unit always stay the same, while the variable cost increases when the total production increases. Because obviously, if you're producing, I don't know, I have here a Coke bottle. Let's use Coke bottle as an example. So let's say you're producing Coke bottles. Then the variable cost to produce one Coke bottle could be the plastic, the material used. The more Coke bottle you have, the more plastic you use. And obviously the amount of plastic doesn't change the more Coke bottles you produce per Coke bottle. So the variable cost per unit does not change, but the total variable cost per production changes. Obviously, if you produce 2 bottles, then you will need to pay for more plastic than if you pay for 1 bottle. Secondly, the fixed costs. And there, the most important thing to know is that the fixed cost per unit decrease as production increases. So while variable costs stay the same per unit, fixed costs decrease. Fixed costs per unit decrease as production increases. And in managerial accounting, there's also 2 different types of fixed costs. There's something called the committed fixed cost, which is basically any fixed cost that's hard to change. For example, if you buy a building, it's kind of hard to decide, oh no, I want a refund on the building. And it's kind of hard to change that cost. Or for example, certain salaries, if you hire a new CEO and promise him, I don't know, $1 million per year, you can't really change the salary just like that. It's a simple decision. It's not that simple. While discretionary fixed costs are fixed costs that can be changed very quickly. For example, a marketing budget. If you see that the company is going well, you can very quickly allocate more budget to marketing. So yeah, that's something always to keep in mind between committed and discretionary fixed cost. Then there are also 2 types of other costs that need to be remembered, but this is also something we saw in BOSC 1. There's 2 types of costs. Also, there are direct costs, which are costs that can be directly attributed to a particular product. Let's take the plastic of the Coke bottle again. A direct cost would be the Coke, would be the plastic for it, because you can see the plastic is directly attributed to the singular product, while indirect costs are all types of costs that cannot be attributed to a particular object. For example, let's say that a factory produces not just Coke bottles, but also makes Sprite and iced tea, then the lighting used in that factory cannot be attributed to a single product because there's no way you can say, oh, with that 1 Coke bottle, I used 5 cents of light. There's no way. So yeah, that's also 2 different types of costs to keep in mind. Then Section 3 is all about the different ways of calculating variable costs, fixed cost. I believe he has 4 methods. So the first method is, wait, Lorraine, one question.
Yes.
Last semester that you don't need Excel for the final exam? Because last semester we didn't need it. We could do everything with a calculator. Is it the same this semester?
I think so.
Okay. I mean, if he didn't say anything, then I think so. Well, let's assume that you don't need Excel.
I actually don't know. If someone else knows here.
Because the final exam you gave me, you don't need Excel for that. So I'm assuming you don't need Excel.
Well, from what I did so far, I didn't need Excel.
Okay, yeah. So let's say for the final exam you don't need Excel. That was our case for our exam last semester. So the scatter graph method, you probably won't be able to do this without Excel, but I'll just quickly go through it in case you have a theory question about that. Basically, what is the scatter graph method is you have your data, you insert a simple scatter graph on Excel, and then you see how the relationship is. So for example, if it's linear like this means that the more activity there is, the more the cost. While if, for example, if it's, let's say, a flat line comes out, this means that the more activity level doesn't mean that there's more cost. But you probably won't be asked this because you don't need Excel. Second, we have something called the high-low method. The high-low method consists in finding the variable cost and the fixed costs, and it's always by using an average between an activity that involves the highest level and an activity that involves the lowest level activity. And you also use that by finding the cost attributed to that level of activity. Let's take an example. Let's say housekeeping department. Let's say on a specific day it cleans 800 rooms in a hotel on Monday, and let's say on Wednesday it only cleans 400 rooms in a hotel. This means that 400 will be the lowest level activity and 800 is the highest, and the cost associated to it, let's say it's 100 for the 800 and 50 for the 400. So what you would do is you would find the change of cost, so 100 minus 50, and then the change in activity level, so 800 minus 400, and you divide that, and what you find there is the variable cost per unit, or the variable cost per unit, exactly. And then to find the fixed cost, what you do is you find the variable cost that you found earlier by doing the high-low method, and then you times that times the level of activity. So in this case, I always use the highest level of activity. So in this case, it'll be 800. Afterwards, if you guys want, you can always look as an example, an exercise. And then you take the total fixed cost, you take the total cost of that activity, you do minus the total variable cost, and that's how you find the fixed cost. But I have it also down here. Total fixed cost is total cost minus total variable cost. And then finally, there's the regression method. And there, the most important thing that you need to know is the 2 points at the bottom, which is intercept and clients. It can be called clients, it can be called rooms cleaned, doesn't matter. But the most important thing that you need to know is that intercept is always the fixed cost, while the second one, in this case it's called clients, is always the variable cost. And to find, when you get a regression model like this, he will always ask you to find the cost function, which always follows the structure of a normal function, so ax plus b, where a is the variable cost and b is the total fixed cost. So in this case, a would be the clients, so 3.52, while the fixed cost would be is always the intercept. So in this case, the cost structure would be x times 352 being the variable cost, plus the intercept, the fixed cost, which is 540. So always remember, the fixed cost is the intercept, while the variable cost is the one under it. And you need to just substitute then A with the variable cost and then the B with the intercept, and then you have your cost function. Then section 3 also is a very important section because it talks about contribution margin, which is a huge part in managerial accounting. A new way of calculating the final operating profit. It's very helpful because it helps you to clearly see the difference between fixed costs and variable costs and how they interact with each other. So the classical method, which we've seen for now in FA and TIFA, involves the sales revenue minus the COGS, and then you do that minus the operating expenses to find the operating profit. Well, the contribution margin method, you still start with the sales revenue, but then you do minus the variable cost. And sales revenue minus the variable cost is your contribution margin. You minus that with the fixed cost, and then you have the operating profit. That's all what there is to it. You just have to remember that contribution margin is always sales revenue minus variable cost. And then if you want to find the operating profit, it's always minus the fixed cost. Then section 4 talks a lot about the break-even point, how it's used, and the different formulas to calculate it. What you need to remember is there are two types of break-even point. The first one is called quantity break-even point, which basically means how much you need to sell to reach the break-even point. And to calculate that, you have to do fixed cost divided by contribution margin per unit. The contribution margin per unit, it's basically how much contribution margin you have per unit sold. So let's say, for example, Coke bottles, you have a total contribution margin of 50. You sold 50 Coke bottles. That means that each unit has a contribution margin of 1. So to find the break-even point of quantity, you do the fixed cost divided by the contribution margin per unit. And then the second one is called revenue break-even point. And in that case, you find how much revenue you need in order to reach a break-even point. And that one, to find that one, you have to do the fixed cost divided by the contribution margin rate. The contribution margin rate, it's the total contribution margin divided by the revenue. And then you do fixed cost divided by contribution margin rate to find the break-even point in revenue. I don't know if you guys know him, Francois, Alexandre, William, I can't remember his name. He always said, is this fine for this? So I hope this is fine for this. And that you'll understand it. But I mean, as long as you use the two formulas that you have here, either for break-even point. Oh, I can see you guys know him. Oh, that's good. I hope you liked him as well. I thought he was really good. So as long as you use these two formulas, then you got it. Just put it on your cheat sheet. There's no need to remember them. But they're important to know. Doesn't mean that you don't need to know them. And just quick, the CVP graph, it's basically another way of representing the total sales and the break-even point. So the total sales is the green line, total cost being this grayish line, and the blue line is the fixed cost. So, and the area in the middle is always the variable cost. So it's a total cost minus the fixed cost. That's how you can interpret it. And the break-even point is where the total sales crosses with the total costs. That's all what there is to this graph. But luckily, you will, at least for me, luckily, because I hate drawing graphs, you will not be asked to draw it since it's multiple choice. Worst case scenario, you'll be asked to interpret it. That's always you need to know that here in the middle, you have the variable cost, and where it intersects, that's the break-even point. Then there's two other important formulas that you need to know from section 4, which is the target profit. So target profit, basically, with these formulas, is you find out how much you need to sell in order to reach a wanted profit. There's two types of formulas, one where you consider tax and one where you don't consider tax. So if you don't consider tax to find the target sales, so target sales being how much you need to sell in order to reach the desired profit, you do the fixed cost plus the target profit. The target profit, you will always be given it in a problem. It's not like you don't have to invent hot water. And then you divide it by the contribution margin per unit, which is what we just saw before. Otherwise, if you consider tax, then you use this formula here, which is more or less the same thing, but you just divide it by 1 minus the tax rate. So that's also two very good formulas to have on your cheat sheet. Definitely recommend it. Then one of the harder things of this course is how to find the break-even point if you have multiple products. Because for now, we've only seen how to calculate contribution margin if you only have one product, only Coke bottles. But let's say that you sell multiple products. So you want to find the overall contribution margin for all the products and not just for one single product. So let's take, for example, two very loved products, the EHL chocolate and the BDS cocktail of the day. BDS cocktail of the day being very popular now with exam season. So let's say that EHL chocolate, you sold 100 pieces, which is the unit sold here on top. You made 1,500 francs in revenue. Your variable expenses were 500 francs. Your contribution margin being sales minus variable costs, so 1,000 francs. And since BDS cocktail costs more, but it's also more popular, it made more sales. In this case, 7,800. Variable expenses being 1,200. Sales minus variable expenses. Then we have 6,600 as contribution margin. So what do you want to do to find the overall contribution margin ratio? Is you want to sum these up. You find the total, so the total sales, the total variable expenses, and the total contribution margin. And then you find the contribution margin rate for the total. Remember the contribution margin rate being contribution margin divided by revenue. So you do that for the total. And then you do the contribution margin, you do the fixed cost, which here I put as 1,900. You put the fixed cost divided by the contribution margin rate. So it's basically exactly the same formula as we saw before, being fixed cost divided by contribution margin rate to find the revenue break-even point, except for this time, you find the total contribution margin of all your products. And that's the contribution margin ratio. And then there's a second method, which is called, it moved, but it's supposed to be up here, but it's weighted average. It's called weighted average contribution margin. What you do in this case is you have to find the contribution margin per unit of each singular product. So in this case, we sold 100 EHL chocolates. So you do contribution margin per unit, it's contribution margin divided by units sold. So you do 1,000 divided by 100, gives us a contribution margin per unit of 10. Same thing for the cocktail, which gives us a 26. And then what you want to do is you find the sales mix. The sales mix, it's the percentage of sales of a particular product. To find the sales mix, what you want to do is you take the sales amount of a particular product, so the units sold of, let's say, EHL chocolate, and you divide that by the total amount of units sold of all your products. So in this case, the total amount is 400. So what you want to do is to find the sales mix for EHL chocolate is 100 divided by 400, which is 25%. And then the other one, you do 300 divided by 400, which is 75%. And then to find the weighted average contribution margin per unit, you do the contribution margin of one product times its sales mix plus the contribution margin of the other product times its sales mix. In this case, it's 10, so the contribution margin per unit of the EHL chocolate times its sales mix, which is 25. Oops, sorry guys. And then you sum this up with 26 times 75%, which is the contribution margin of the BDS cocktail. And then there you find the contribution margin per unit, which is of the two products. So it's basically an average of the two contribution margin per unit. Just to remember, with the second method, you can only find the contribution margin per unit, while with the first method, which is, where's the slide? Here we go. With the first method, you can only find the contribution margin rate. So they're not changeable. With the second one, you only find the contribution margin per unit. With the first one, only the rate in revenue. So, and then section 4 has the last part, which is called operating leverage, which is kind of the same as elasticity in microeconomics. I personally sucked at microeconomics. It was not fun. So I'm not going to be here and explain what it is because I wouldn't be able to tell you either. But the most important thing that you need to remember here is that operating leverage basically tells you how sensitive your operating income is to percentage change in sales. So, for example, a very high operating leverage means that if your sales only changes by 2%, you get a much higher profit than if your operating leverage is very low. And the operating leverage is calculated by contribution margin, so total contribution margin divided by profit. And then it happens quite often that he'll ask you then a second question where he tells you, well, how much does will the profit change? In that case, you just do operating leverage times the percentage change in sales, and there you'll find how much the profit will change in percentage. And finally, for section 4, there's also something called the margin of safety, which means how much money you can lose before starting to have negative profit, meaning how much money you can lose before reaching the break-even point. And to find the margin of safety, all you have to do is total sales divided by break-even point in revenue. And then here, when I'll send you the slides, you have a little exercise, which I think is really good that you can then practice with. There we go. So, section 5 is all about job order costing, meaning how to associate a specific cost to a specific job. And the most important part that you need to know about this section is quick recap on the two costs that we saw. The DMC and the DLC are the direct material cost, and DLC being the direct labor costs. These are very easy to assign because, for example, let's say the Coke bottle again, it's very easy to say, oh, 200 grams of plastic, direct material cost, that costs us 2 francs. We already know that. So it's very easy to associate to a specific product and to budget. While the manufacturing overhead, as we saw, it's literally anything that's factory related. So it has many different costs, many different costs and many different costing objects. So it's almost impossible to associate to one specific job. It's the same thing that I told you before with the direct and indirect costs. It's kind of the same reasoning. So the challenge here in the job order costing is in the fact that you have to know how to attribute the manufacturing overhead to a specific job. So let's skip this, not that important. So what you want to do is to find the overhead, the manufacturing overhead for a specific job, is you want to calculate something called the predetermined overhead rate. To do that, what you want to do is you use the total manufacturing overhead of the total production of that year, and you divide it by something called an allocation base. An allocation base can be anything. It can be machine hours, labor cost, the kilogram of products used. It can be the amount of staff. It can be anything. And what you get there when find the predetermined overhead rates, what you get there is a percentage or a fraction, same thing. And then once you have the rate, you times that rate times the amount of allocation base for a specific job. So let's say, for example, that I create paintings. My allocation base is, let's say, kilograms of paint. I use 100 kilograms. My overhead is 100 francs. I use 50 kilograms of paint. So 100 divided by 50, that's 2. So my predetermined overhead rate is now 2. And then let's say I painted a beautiful painting using a lot of blue color. And I want to find the manufacturing overhead cost of that specific painting. So what I do is I use, let's say, 2 kilos of that blue color. And that's my allocation base, kilos of paint. So I do 2 kilos of that blue color times my overhead rate, which we found was 2. And that gives us then a manufacturing overhead cost for that specific job of 4. And then that's how you will find it. And very important to remember that the predetermined overhead rate is an estimate. So it's used to, as we saw in the very, very beginning, managerial accounting is all about predicting costs. So we use it to predict what we think this specific job will cost. And then we will find out actually how much it did cost once everything happened. So it's an estimate. It's not something that happened really. So keep this in mind. Remember it in case he wants to trick you or there's a theory question about it. So if you guys want, we can quickly do an exercise on predetermined overhead rate. Just spam the chat. Let me know if you want to do the exercise quickly together. Or emojis. I think they're cute. Do you guys want to do the exercise? Yeah? Okay. Sounds good. So in this case, we have we know the overhead cost, which is $350,000, and it's related to 4,000 hours of runtime for specialized machinery and equipment. We know that they use machine hours as an allocation base. So in this case, the total is 4,000, and so calculate the predetermined overhead rates that will be used to apply. So if anyone wants to calculate the overhead rates, because if I do, it's going to be way too easy. If you guys need the formula, just let me know. But I mean, that's the formula. And you know that you need 4,000 hours. That's your total location base, and your overhead manufacturing overhead cost is 250,000. How much do you guys think the rate is? Any ideas? I'll give you guys a minute. 87.5. Let's see. Yep. Yeah. Agreed. And then so that's your rate. And then the second part, they ask you if the specialist machinery is run for 250 hours, calculate the amount of overhead that will be applied to that job. So you know that the overhead rate is used machine hours as an allocation base. So then to find the total overhead for this specific job, you do your rate times 250. That's all there is to these type of exercises. So it's really just using this formula right here, and then you'll find then everything from there. And then something else that's very important to remember is when a certain cost is under-applied and when a certain cost is considered over-applied. So if the actual costs are bigger than the applied costs, this means that the total costs are under-applied. Well, if the applied costs are bigger than the actual, then it's over-applied. That's all what there is to it. There's nothing more. Like, this is also a good slide to have on your cheat sheet. Okay, there we go. So section 5 is all about service department costing as well. Give me a second. Yeah, and then section 5 continues with something else called service department costing, which means allocating specific costs of a department to another department. Let's say, for example, a janitor, that will be janitor department or cleaning department. Obviously, a cleaning department doesn't create value, doesn't create revenue. It only has costs. So you want to find out that janitor service, how much it costs for each department that makes revenue. So for example, let's say that the janitor will clean, let's use the Coke factory example. Let's say it cleans the factory floor for $400 a bit much. Let's say 4 hours per day. And then it cleans the kitchen for 2 hours a day. Obviously, the factory floor will have a higher department cost because the janitor will work more there than the kitchen because he cleans the kitchen less than the factory floor. So department costing is all about finding out how much to allocate to each department. There we go. So to find out how much how to allocate the cost, you have to use something called the step method. So as I say here, it's a way of allocating cost based on units. So I said janitor, cleaning hours, it can be number of employees, square meters, can be anything. And it's really good because it's quite precise, as it considers the assistance between service departments. As I said, the janitor helping out the factory floor, or let's say the management department, also considers the cost of HR, for example, for the specific employees working on a specific floor. So it's quite precise. The negatives, it's really long. The step method is really long. Personally, the thing that took me the most to figure out, at the beginning, I could not understand it whatsoever, because I personally think that they were explained really badly in his slides, but my opinion. It takes a lot of practice to do and to understand. It took me a lot of time to understand it, and it's a pain in the ass to do. You will probably be asked to do this in the exam. It will take you a lot of time. So to be quick, I'd recommend to just do a lot of exercises on the step method. But luckily, I will now explain to you, to the best way that I can, how the step method works. So, step method always starts out this way. You get something called indirect costs, which are attributed to each department, and then the allocation, I call it allocation base, it's fine, of each department. So let's say, for example, the management department allocates its costs to each department in ways of number of employees. The cleaning department does it in square meters. Well, makes sense, because the cleaning department allocates its costs in square meters, because the more square meters they clean, the more they cost. So that kind of makes sense. While the production allocates its cost based on working hours, which also makes sense, because the more you run a specific machine, the more it's going to cost you. The more it produces, the more it's going to cost you. Okay, and then what you have to do to find the step method is, so you always start out with the first one. So in this case is management. You calculate the total allocation base, ignoring the first one, ignoring the number 5, because what you do is you want to find the allocation base of management for the other departments. So obviously you don't consider the employees already working in management to give the allocation base to other departments, because obviously the 5 employees that are working in management, they're not working in the cleaning department. So it makes no sense to consider those. So what you want to do is sum up the number of employees for the other departments, so 10, 20, 60, 30, which gives us 90, which gives us 120. And then to find the cost of management to each department, you do the number, in this case, the number of employees divided by the total number of employees for all the other departments. So in this case, what you want to do is 10 divided by 120, and then you times that times the indirect costs of management, which would give us, in this case, 20. So the allocation base for management costs is 20 for the cleaning. And then for maintenance, same thing. You would do the number of employees of maintenance divided by the total number of employees, always obviously ignoring the management. So in this case, 20 divided by 120 times again the indirect cost for management, which will give us 40. Same for production, same for delivery. Then to do cleaning, you take the other one, square meters, same thing. You ignore the allocation base attributed to the cleaning, so you only take these 3. You sum them up. In this case, this gives us 44. And then same thing, to find the costs of maintenance, what you want to do is you want to take the total indirect cost of cleaning, which, watch out, because in this case, you have to consider also the ones we gave to management. So in this case, the total would be 220, not 200. You always have to sum it up and then start from the beginning. So you take the 220 times the number of the square meters, which in this case we said was 44. So you do the square meters of maintenance, so 8 divided by 44 times the allocation cost of cleaning, which is 220, which will give you 40. Same thing for production, same thing for delivery. Total, you always have to find the total. And then you do the same thing for what's next, for production. And then for production, what you want to do is same thing. In this case, production is working hours. So same thing, 50 divided by 30. You find the allocation base for everything. And then that's how you then go on for all of it. So, and then for this, and yeah, that's then your step method. So you find the allocation base for management, cleaning, maintenance. You have these two, and then that's all what you need then for a step method. Because if you look at here in this case, management is number of employees, cleaning is square meters, and working hours is for maintenance. And there you have then the allocation for the two service departments, which create money, which is production and delivery, which is what you want to find ultimately with the step method. The total cost for the two departments that create revenue. And then there's a second method called the direct method, which is much easier, much quicker. Basically, it ignores that. Very simply said. You don't have to use the allocation base for management, cleaning, and maintenance, meaning that you don't have to do like the total. What you want to do is you just do the allocation base for production and delivery times management, times cleaning, times maintenance, which are without considering the intra departments. Then you find different numbers, but it's much quicker. But in the exam, he always asks for the step method, not the direct method, because it's much longer and obviously more complicated. Then section 6, personally, I don't like it for simple reasons. So good news, there are not a lot of formulas or math involved in section 6, meaning that you don't have to learn formulas. There's not much to know. The bad news is there's not really a trick that works for the exercises. You have to do like each and every exercise is different. For this section, there's no one formula that works every time or one trick that works every time. You just have to get an eye for it and learn how to work with it. But I'll try my best to explain it. There are a few rules still, but not that much. It's mostly just about exercises. So what are relevant costs? Well, it's relevant costs that need to be taken into account when making a decision. This means, for example, if you want to buy a new machine, and a completely irrelevant cost would be the lighting of the factory floor, because why would you care about that if you want to buy a new machine? While I got confused. Went back, sorry. So the irrelevant costs, the irrelevant costs are the lighting that you use, while relevant costs are costs that you have to take into consideration when making a decision. So costs that you have to take into consideration when, let's say, buying a new machine is the difference in price, the output, maybe the amount of electricity. If one is stronger, it uses more electricity. Sorry, I hope it didn't confuse you guys too much. But relevant is stuff you have to consider. Irrelevant is stuff that you don't have to consider. The irrelevant costs are also known as, So the relevant are the avoidable ones and irrelevant. So then for irrelevant costs, which are the unavoidable costs, sorry guys, I am a bit tired. They can be divided, it's costs that you will have no matter what your decision is, you will always have these costs. So they can be divided up into two parts. One is the sunk cost, which are costs that already have happened and cannot be avoided. This is, for example, rent. Rent is a great example of a sunk cost because it's a cost you have every time in the beginning of the month. And let's say in the middle of the month, you decide to buy a new machine. Well, tough luck. Sunk cost, you've already paid it. So there's no need to consider it if you want to buy a new machine because it's already paid, the money's gone. While future costs are costs that don't change whatever alternative you choose. Let's say, for example, let's do my job. Let's say you hire a consulting company to help you choose which machine to buy. A future cost would be paying the consulting company because it doesn't change, like the fee you pay to a consulting company, it doesn't change whether you decide to buy machine A or machine B. So future costs are costs that don't change, whatever you decide. This can also be, for example, salaries. Usually they don't change. While some costs are costs you've already had, so there's no need to consider them anymore because the money's already gone. Then there are a few scenarios when to consider for these type of exercises. The first scenario that you might encounter is scenarios where you decide whether to add or drop a product. So when considering if to drop a product, you must consider which fixed costs will disappear. And fixed costs that disappear are costs which are only associated with the product line, meaning not the lighting. Basically, direct material cost, direct labor cost, fixed costs attributed to the product line, that could be a salary. While you don't have to consider the lighting because that's not attributed specifically to the product line. And a good way to remember this is the only formula I could find, basically in this whole chapter, is that if the contribution margin minus the fixed costs that you drop, if the result is positive, then you want to keep the product. If the contribution margin minus the drop fixed cost is negative, you want to drop the product. That's how you decide whether to drop or add a product, to drop or not to drop the product. Yeah, remember one thing, common costs, which are costs shared by everyone, also known as indirect costs, they do not disappear, obviously, because they cannot be attributed to a single product line. Then, if you guys want to have an exercise afterwards, we can do that. But I want to give more time at the end. If you have any specific questions, then I'll try my best to answer them. Prefer to leave that more at the end. Then, secondly, there's something called joint products, which are products that you can have from the same starting product, which then can split up into multiple types of product for different uses. A good example for this is crude oil. As you guys know, crude oil, depending on how you refine it, it can either become gas for cars, for airplanes, it can become cooking oil, I think. Not the biggest experts, but I know it can become gas for boats. So joint products are products that start from the same base, but then can become many different types of products used in different situations. And then we also have an exercise. This, I want to quickly go through it, because I think it's still very important, and I have this in my final exam. Sorry. Basically, what you want to do is find the sales value after processing, and then the sales value at the split-off point. Usually you can calculate that, you have that already, it's given, you just do one minus the other. There you find something called the incremental value, the incremental revenue or incremental value, same thing. And that is basically how much revenue you get additionally if you decide to split a product or not. And then from the incremental value, you find the cost you do minus the cost of further processing. And there you find if it's worth it to split a product or not. So if your result is negative, it's obviously not worth it because you don't get that much revenue. You don't get any revenue if you split a joint product. While if it's positive, it means you do get revenue from splitting products from one product getting joint products, and then in that case you want to split it. Then next chapter is all about budgets. Budget is basically a detailed plan for the future, which takes into consideration revenue, costs, and profit. Well, from the revenue and the costs, you get profit, obviously. And usually a budget that covers 1 year period. 1 year period, it can start any time, but usually in firms, it starts a new year and ends at Christmas. So usually the typical calendar year. And then there's something called a master budget, which is basically the budget for the entire company. So each department of a company makes their own small budget, and then they all get put together for the master budget. There are 3 types of budget. There's something called a participative budget, in which you tell each manager of each department, hey, please create for me the budget for your department. The good thing about this, it can create great motivation because the manager feels included into executive decisions. So it can lead up to motivation. But the problem is that the manager can be smart about it. He can say, hey, I'll make less revenue and then more costs, give that as a budget. And then once they see that he overachieved, meaning that he made more profit than initially thought, he'll get his bonus. So it's kind of risky as well. Increment, then there's two types of ways to create the master budget. The two types are called incremental budgeting and zero-based budgeting. So the incremental budgeting, it basically consists of taking last year's master budget, copy and pasting, and then changing a few numbers that might have changed, but not much. Zero-based budgeting, which is much, much better, much, much precise, and will help you in the long run, means making the budget every year from scratch. Obviously, requires a lot of time, a lot of effort, but this way you know that the budget is more precise. And here you can see a quick rundown of the elements of a master budget. The master budget always starts with sales, so you always predict revenue, and then from the revenue you create all the other elements. So production budget, ending inventory budget, selling and administrative budget, all those kind of budgets, and then you do one minus all the costs, and you end up with the cash budget, which is the cash that you hope you have at the end of the year. So there are different types of budgets. The first one is called the sales budget. And to find the sales budget, what you want to do is you take accounts receivable of last period, you do plus the total sales for the period minus the accounts receivable for that period, and there you have the total cash collection for the period. Secondly, you have something called a production budget, which you find by doing your sales. It always starts with sales plus the desired ending inventory. You get how much you actually need, minus the beginning inventory, and that's how much you require, how much you want to produce in order to achieve that budgeted sale. So basically, what production is how much you need to produce of a certain item to achieve that sales budget, that predicted amount of sales. Finally, something called the direct materials budget. Same here, what you want to do is take the raw materials. Here's the only case it does not start with the sales. You want to take raw materials needed, plus the desired ending inventory, minus the beginning inventory of the raw material, and there you have the raw material that you need to purchase, which is basically what you need to do during the year to achieve your raw materials needed for the production. And if you find out correctly the raw materials needed for the production, you therefore have the correct budget for the production, and therefore the correct sales, and therefore the correct profit. So as you can see, it's all interlinked, and if one is wrong, if one is screwed up, then they're all going to be wrong, and you will not get the profit that you budgeted. Finally, there's something called a flexible budget, which takes into account changes in revenue and costs. So obviously, during a year, a lot can happen. There can be changes of plans. Maybe you realize, hey, my Coke bottle is doing way better than I thought. Let's bump it up. Let's bump up production. So that will be a flexible budget. To calculate the flexible budget, what you want to do is basically to do one minus the other. So it's very brutal to say it this way, but yeah. What you want to do is to find what you budgeted in the beginning, minus what you actually have right now, and then there you can find the change which occurred. And there you have your flexible budget. And then finally, there's section 8, which is the last section, which is a very easy section because there's only four formulas you need to know for this section, and then you can do every single problem of this section. Just a bit of theory behind it. Variance analysis means finding differences between standards of the company and what actually happened. A standard could be, for example, we predict standardly that to create the Coke bottle, we require 20 grams of plastic. And then you find out that actually you used 22 grams of plastic instead of 20. And variance analysis just means that, finding the difference and finding out why that difference happened. The 4 formulas that I promised you will only use these 4 formulas, put them in your cheat sheet. Definitely useful. It's price variance, meaning how to find a price variance, materials variance, labor rate variance, and labor efficiency variance. So you need to have these four formulas. Here are all then the table with all the meanings. So AQ is actual quantity. Actual quantity is what you actually used, as the name says. Actual price, what you actually paid for it. Let's say standardly for 20 grams of plastic, you want to pay 2 francs, but this year, for some reason, your supplier decided to charge you way more. So that will be your actual price. You have your SP standard price, SQ standard quantity, AR actual rate, and SR standard rate. And they're always given these. So what you want to do is you just plug them in the formula, and then you find your variance, materials variance, labor rate variance, and labor efficiency variance. The only worded theory that you need to know for this is he will always ask you, is this result favorable or unfavorable? Well, if the result is negative, then it's favorable. If it's positive, then it's considered unfavorable. Because obviously, if it's negative, it means that the actual quantity was lower, which is great. While if it's positive, it's unfavorable, it means the actual quantity was higher, which would not be good and would go against the standard, so it means you lost money. And that leads me to the end. I covered all chapters more or less, giving you the most important formulas, the most important things they need to know. Well, I'll just leave you guys by saying good luck for the exam. Something that I love to say to all my friends, they hate it when I tell them. And finally, something that I always tell them is enjoy the exam and have fun. It's important to enjoy the exam. If you enjoy it, you'll do well. And have fun, because you only get to do it once. I know it sounds very evil, but I'm sorry. Now, if you have any questions about the final exam, how you think it is, anything that you want to know about it, then go ahead, ask ahead. One tip I can give you is sleep before it, because I made the mistake of not sleeping before it, because I thought I was really ready for it. I was, but I didn't sleep because I took it too chill, and then I ended up being half asleep for the final and then making stupid mistakes. So make sure to get rested. And so there's a question for your exam. What was the ratio of theory and calculation questions? Oh God. There were 45 or 50 questions, something like that. It was like 10 theory questions and the rest was calculation. Like, it's mostly calculation questions. The first 10 were theory. And then in the theory questions, there's maybe a part where he tells you to calculate and a part that he tells you theory. But it's mostly calculations. It's mostly, if you look at the final exam, that's a really good example. You have different case studies. Like the beginning, it's all theory questions. And then you have case studies, which is calculations. That's exactly how the final is going to be. It's going to be theory questions at the beginning. And then the case studies, that's all calculations. Did you feel like you had enough time during the exam? Yes. Yes, I did. I think I had enough time. I remember when I did the mock final exam for my first tutoring I did, I was much ready than this time. Sorry to say, but that was true. For the final exam, I finished it 10 minutes earlier, and this was me being half asleep. And basically, there were some things I didn't see, and I made stupid mistakes. But yeah, no, you have time. The tip that I give you is know how to do all the exercises that you have. If you know how to do all the exercises that you have really well, then you're good. So just know how to do the exercises, and then you'll be fine. Just practice on those.
I had a few people asking if you could just share your slides as well.
Yeah, I will.
You don't have to. But if you want.
Yeah, I will. I'll send you the slides.
Perfect.
Actually, can I share it in the chat? Or
I think
no?
you can actually.
I think I'll try to share it in the chat. Let me see if that works.
Thank you. That was really clear and good, so thank you very much.
Great, you're welcome. I'll give you guys a tip. Practice the step method. It's really evil. Wait, let's see if I can share it in the chat. Well, Lorraine, I'll also send it to you per email,
Perfect.
just so you have it in case, I don't know, the chat is.
Yeah, so I can put it on the website as well, and then.
There you go. I think it's uploading right now. I mean, just or wait. There you go. You can just like take it from the chat and then just put it on the website.
Perfect.
Great. Thank you guys so much. Hope you enjoyed it. If you have any questions, wait, I'll write you guys my email address in case you have any questions. Just email me or send me a chat on Teams.